Hello friends, last week in my video, I discussed with you whether the fall in the US markets would impact the domestic markets here. And let's hear what exactly did I say as a recap. Since the market is already under an overhang of pro-cyclicality, any weakness in the US market, yes, therefore will possibly drag the Indian markets lower. You think you will defy gravity forever? Sorry, statistically speaking, not happening. So, in this week's video, I want to discuss with you whether the fall is done, is the market ready and ripe to rise again, and what should be your strategy going forward. Do remember, this week is a shorter one because on 15th August we have a national holiday due to Independence Day. So volatility is likely to be high. Your tail risk hedges should be in place at all times, and the strategy of taking small exposure for large price moves, as I have indicated in this video, should continue to be on the safer side. Now to continue with our usual format of the video, and coming up on your screen is the weekly market roundup. What you can see is that both the headline indices fell, but it was a bank Nifty that led the fall. The US dollar index, the DXY, fell marginally, and that boosted gold price, but silver succumbed to a little bit of selling pressure. Crude oil and natural gas went up. Now, this is a story. Now, this is a time when winter starts on 1st of October, and you already have October futures ready and getting liquid. So price starts to climb in natural gas, and that tends to have a trickle-down effect in crude oil, which also goes up. But on my free Telegram channel, I indicated to you that you should be noting the cost of carry. It's huge. 20, 25, 30, even 40 rupees at times I have seen during winter months as a cost of carry. And you're going to have amateurs and armchair experts telling you that a new bull market has started. It's nothing but a cost of carry. And they might even tell you it's a super cycle which is back in the reckoning. But let's be careful out there. So the energy prices are up. That might weigh on sentiments. And the second thing that may weigh on the sentiments is the USD INR, which is time and again kissing 84 levels, which means the rupee is at all-time lows against the dollar, which is a mild worry. Now, the Indian 10-year benchmark bond yield fell by 2 basis points. That means bond prices went up marginally. But if you've noticed, bond yields have stopped falling rapidly. There is a very mild and minor fall at times. NSE lost 1.5% in market capitalization, which means the rally, the sell-off was somewhat broad-based. Market-wide position limits went up to 41.66%, which is a recent period high. That means traders are taking big exposure. Where the US markets are concerned, the headline Dow Jones Industrial Average fell along with the broad S&P 500. It was the NASDAQ, the tech-heavy index, that made a move higher. Friends, in last week's video, I pointed out to you that the IRS, interest rate sensitive sector, is something that I expected weakness in. This graphic should tell you a story. Now look at what's happened over a 4, 12 and 20 week time frame. If you're looking at the average interest rate sensitive stocks return over a 4-week period, they've returned a negative of 5.11%, where the bank Nifty has fallen 3.43% and the Nifty is barely fallen 0.5%. Over a 12-week period, again underperformance, and over a 20-week period, again an underperformance. So what I'm basically trying to tell you is that this is a sector, banking and financial sector services, which is appearing lagging, sluggish and top heavy. Now, why am I telling you this? Because of a simple fact. We traders are brain warriors. We think with our heads, we strategize and win with our ideas. If you go to the fact sheet of the Nifty 50, you will realize that 34% and higher is the weightage of banking and financial sector stocks in the Nifty, and the number 2, 3, and 4 heavily weighted sectors do not constitute even 34%. So by and large, this is the sector that will determine the fate of the market, of the headline indices, and it's looking sluggish. So if you were to ask me, where is my bias tilted? I would say I'm slightly inclined towards a decline. Now let's go and check out the ratio chart. Remember, I've been sharing this chart with you since about a month. And look at the Bank Nifty versus the Nifty ratio chart. I've already shown you, told you how to get it for free in TradingView. This is another week where the Bank Nifty has underperformed the Nifty 50. And do remember, banking and financial sector stocks have a weightage of 34%. Unless the Bank Nifty versus the Nifty ratio climbs above 2.30, 2.35 odd levels, I don't think a sustainable up move is coming. So let's be careful out there. Friends, let's now come to our in-house indicators. I start with the MWPL, or the market wide position limits. Now, this is the exposure utilized by traders as a component of total exposure allowed by SEBI. At 41.66% in the second week after expiry of the previous month's derivatives, this is quite simply the fastest and the biggest jump in MWPL. What does it tell us? Very simply, it tells me that traders have ramped up positions very, very fast. But do remember, it's a zero-sum game. If bulls are buying, there is also somebody selling aggressively. And I've told you time and again, very high MWPL brings with it high statistical beta, or pure price volatility. Why? Because should push comes to shove and should there be any negative development, such huge positions will see equally fast unwinding. That leads to price shocks, a huge amount of volatility in prices of stocks that are getting unwound. So I repeat my advice again. Keep looking at the MWPL of individual stocks. The stocks with the highest climb in MWPL are the most vulnerable to crowded exit effect. Friends, I now come to the turnover of the index and stock futures, and you have three concurrent series, which is August, September, and October. The index futures turnover rose a little more faster than the stock futures turnover. Not surprising here, because stock futures are more volatile, more riskier, and command a higher span margin. So risk appetite was definitely smaller. Let's now come to the advanced decline ratio. This is an average of all 5 trading sessions of the week. Here the Nifty has logged 1.42% losses, as the red line indicates, but the advanced decline ratio has climbed from prior week's 0.99 to 1.40. That means for every 100 losing stocks, there were 140 gaining stocks. Intraday traders were still nursing a hangover of optimism and they were buying. Now, whether they're going to be rewarded or not next week, that time will tell. Now, friends, the Nifty and the Bank Nifty prompt futures basis. What is the basis? It's nothing but the premium or discount commanded by the future compared to spot. Just like options premium, basis also erodes over time, and the closer you get to expiry, the lower is the basis. Now, we need to watch whether the basis has gone up because of short covering or is it gone up because of fresh buying. So far, MWPL has gone up. So I would say that a little bit of short covering was seen, but some amount of a large amount of fresh buying has pushed basis higher. Will it sustain? Will it fall below zero? Time will tell. And this is a weekly chart. The daily chart is every day updated on my free Telegram channel. The contact coordinates are on your screen. Do make it a point to join me there. Friends, I now come to our in-house indicator, the impetus. You've trusted this indicator for almost 4 years now. Now look at the way the impetus has climbed. This is a weekly chart, and the Nifty 50 impetus has climbed much more faster. The Bank Nifty's impetus has been patchy but gone up higher. And what's happened week on week? The impetus of both indices has jumped. What happened to the indices themselves? Hey, they fell. They fell. That tells you that the fall was on higher selling momentum. Not good news at all. So we need to watch this impetus on a daily time frame. And like I said, the same is updated on my free Telegram channel. Do connect with me there. Now, friends, I come to our exclusive in-house indicator, the lift, weight, thrust, drag indicator, not available anywhere at all on the internet. And what you are seeing is the fall of the Nifty was 1.42% last week. And the LWTD also went into negative from 0.13 positive in the prior week to minus 0.06 last week. Not good news. That tells me that at lower levels, if the market was to fall, buying support will be extremely feeble and mild. So the prices might just try to find equilibrium downwards instead of upwards. Friends, I now come to the bond market, which you know is very close to my heart. I've been putting this market ahead of equities since many years because it funds the other asset classes. Look at how the Indian 10-year benchmark bond yield is down. Definitely, we grant it to the bond market itself. This is the sixth consecutive week the bond prices have closed below the prior weekly close. But the extent, the amplitude, and the ferocity of the decline seems to be slowing down. And this is precisely what I am looking out for. And I told you that this is one of the reasons why I am not buying gilt funds as of now. I'm not convinced that buying is the way to go forward. I would rather wait and keep the powder dry. Friends, the bond market's done. I now come to the Bank Nifty. And as you can see on the daily chart on your screen, this index has risen on 3 out of 5 trading sessions. But the gap down open of Monday has ensured that a week-on-week figure is a net loss. The price has closed below the month-long moving average, which itself is sloping downward. So the short-term outlook is weak for now. Bulls need to push really hard on the Bank Nifty due to the weightage of 34% of banking and financial sector stocks in the Nifty. Turning to the weekly chart now, what we can see is a bearish hammer which tested the 25-week moving average, which happens to be a proxy of 6-month-long holding on cost of an average bull, and then bounced higher. That validates the 25-week moving average as a near-term support. Now, this 25-week moving average is a litmus test of the bulls in the coming few weeks. Currently, it is placed at 49,600, but the value will change daily because the price and the averages will keep getting added and subtracted at the end of every trading session. Now, the bulls will need to take the Bank Nifty above 52,500 on a sustained closing basis to get back in the driver's seat. Week before last, this index was number 5 on our statistical beta rankings that we maintain in-house. And from number 6 in the week before last, it's climbed 1 notch to number 5. That means challenge levels went up marginally. Not a very great feeling. Last week, I advocated a range between 52,450 on the upside and 50,250 on the downside, which was violated on the downside because the low was 49,659. But hey, I did warn you that there was a possibility of the range being breached, and the possibility of the breach was on the downside, not on the upside. Let's check that out. Friends, a word of caution here. I expect the possibility of a breach of the lower support of the range that I specified. Now, in the coming week, I estimate a range between 52,050 on the upside and 48,900 on the downside. Now, how did I know that the ranges would get violated? Possibly rather, then it's very simple. I used the price, volume, MWPL, and the churn ratio. This is something that I have been sharing with you off late, the churn ratio. And last week, the churn ratio fell. And I'm not enclosing the chart because the churn ratio was extremely high in the week prior. I shared that chart with you, which gave a warning. Now the churn ratio is not giving any warning because a fall has already occurred. Does the fall have to be accompanied by very high and heavy volumes? This video that I have recorded earlier should clarify your doubts, and please do watch this carefully. That should tell you how to decipher volumes in a falling and rising market. Now also check out our daily, weekly and monthly pivots that I upload on our daily, our free Telegram channel, and that will help you get more precision into trading as you head into 1st of October, when the number of strike prices on the indices will be reduced, and there you need more laser precision in your trades. Now friends, I come to the Nifty 50, which fell 1.42%, and like the Bank Nifty, it fell on 3 out of 5 trading sessions. But it never really recovered from the gap down of Monday. The daily chart on your screen tells you that the price fell below the month-long moving average, which itself is trended higher. But after opening lower on Monday, it closed above that moving average. That makes this index relatively stronger than the Bank Nifty. Now, the gap that it has left on the open, just like the Bank Nifty's gap, needs to be closed. So currently, the gap will close if the Nifty was to rally in the spot segment above 24,800. And unless that happens, the bulls will not be able to get into the driver's seat. Now let's move to the weekly chart that shows the index logging a bullish hammer far above its 25-week moving average. Now this 25-week moving average is a proxy for the 6-month long holding on cost of an average bull. I have been warning you that the price gap between the moving average and the closing price was way too high. And that meant that mean reversion had to occur. Either the price would consolidate or even fall to touch the moving average and then maybe recover again. So that theory has been validated, but I don't think the period of consolidation or correction is over yet. We'll have to wait and watch. For this, you need to watch the interest rate sensitive stocks. Do remember the earlier chart that I showed you of the IRS stocks. Friends, I will remind you again, it's a shorter week due to a holiday on 15th August. So please do trade light and keep your Hacienda hedges in place. The Hacienda hedges are explained in this video, and do watch the description for the hyperlink as well as the pinned comment, where I have put up hyperlinks of all the videos that I want you to watch. Now friends, in the week before last, this index was number 11 on our statistical beta rankings of volatile counters. It climbed up 3 notches. Now that is not good. It's a broad-based frontline index. Volatility has gone up. That means challenge levels for the retail guy has increased. Last week, I advocated an estimated range between 25,300 on the upside and 24,125 on the downside. Here again, exactly like I warned you, the breach or the violation of this range was onto the downside because the low was 23,893. In the coming week, I estimate a range between 24,950 on the upside and 23,750 on the downside. Please watch our daily, weekly and monthly pivot levels for more precision levels in your trades. Friends, I now come to the last bit of technical analysis and statistical analysis by way of identifying the risk appetite of the retail traders by their footprint in the 4 F&O segments. Now take a look at the weekly chart on your screen. The index futures have contributed 2 basis points higher turnover. It's indicated as a blue line. Where stock futures are concerned, they've contributed 1 basis point less turnover, indicated as a red line. Index options turnover contribution fell by 21 basis points, shown as a green line. And stock options turnover went up by 20 basis points. It's indicated as a purple line. Now, frankly, the risk appetite was far below desired levels. If the rally is to continue, bulls will really have to push a whole lot more harder. This kind of a safe play won't really cut ice and push the market significantly higher. Now, friends, I come to my strategy for the week ahead. Last week, I told you that the interest rate sensitive stocks was a soft underbelly of the market. Sure enough, it fell, and theta decay on these counters would have given you positive returns. Incidentally, the combination of price, volume, market wide position limits, and churn worked fairly well. I would say like a charm in many of these counters on an intraday as well as swing basis. I will continue to focus on this segment in the week ahead. Public sector units, especially public sector banks, OMCs, oil marketing companies, and energy and power distribution and generation stocks will remain on my radar for two-way price moves because these are a lot more volatile as compared to the broader market. Oil and gas are showing signs of perking up because of winter, which results in oil prices and gas prices going up due to internal heating demand. Like I told you, it's not really a bull market, but it's only cost of carry, which is pushing up prices. So just don't get excited by calls of super cycles or bull markets. This is a process that lasts till the vernal equinox in the west that coincides with the Holi festival in India. I will continue to seek theta decay in oil and gas wherever I can, and I remain positive on bullion for the long term investors. The outlook in the absolute near term is cloudy, but then that's always been the case ahead of the elections in the United States, and after which I expect bullion to outperform the current movement that it is showing you. I'm still not getting into gilt funds like I've told you earlier. I'm keeping the powder dry and waiting and watching. Primarily, being a short week, I will take smaller exposure levels here. Friends, I wish you Independence Day wishes in advance. And if there are any more ideas that I need to share with you, please join our free Telegram channel. The contact coordinates are at the fag end of this video as well. I thank you for being with me in this video. Till we meet again, this is Vijay Bhambwani signing off for now, but not before reminding you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, please do let me know how my videos are helping you become better traders. And hey, a request. Please share my videos with all your friends and social media groups so that I can reach across to smart traders like yourselves and spread the cult of knowledge-based investments and trades. Thank you for your patience. Till we meet again, this is Vijay Bhambwani signing off. Have a very profitable week ahead. Take care. Bye-bye.